Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Jing Yang, head of North Asia Industrials, Property, Consumer, and Utilities at Fitch Ratings. In today's podcast, I'm joined by my colleague Jing Yang, director of Fitch Ratings, to discuss the current state of China's solar PV manufacturing industry. Jean is based in Shanghai and she has been with Fitch since 2014. Jean, thanks for joining the podcast again.
Thanks for having me in. My pleasure to share our latest observations on the Chinese solar PV industry here.
Thank you, Jim. As we all know, the Chinese solar PV manufacturing industry is highly cyclical. As of middle of 2024, the capacity based in China accounted for over 90% of global capacity across key segments of the value chain. The industry has gone through a couple of big swings over the past decade due to regulatory changes, trade policy changes, demand fluctuations, and also capital market volatilities. So ups and downs are pretty common in this industry. And as we speak now, the industry is clearly in another down cycle, which started about a year ago. So maybe can you start with a quick overview of the current state of the industry and explain how it got to it?
Sure, let me give a quick recap at first. In terms of pricing, the Chinese solar PV industry has been in a downward cycle since its peak in November 2022, experiencing a continuous decline for the past 2 years. The major segments within the industry chain, especially upstream polysilicon manufacturing, have faced dramatic fluctuations in prices and profits. Since May 2024, polysilicon prices have fallen below the cash cost for all manufacturers, hovering around a low of 40 RMB per kilogram. This compares with over 300 per kilogram in the 2022 peak. Prices for midstream and downstream segments like wafers, cells, and modules fell accordingly and have continued to edge down in recent months due to oversupply. In the second and third quarters of this year, most companies in the Chinese solar PV industry chain, including the market leaders, were operating at a loss, with only a few companies with exposure to overseas solar and energy storage business managing to remain profitable. Unlike previous down cycles caused by demand shocks, the current industry challenge stems from severe oversupply. Amid an unexpected surge in demand during 2022 to 2023, industry leaders aggressively expanded production capacities. On top of that, extraordinary profits and policy support also attracted significant capital from enterprises from other sectors, local governments, financial institutions, and capital markets. This influx of funds fueled capital expenditures that far exceeded actual demand. On these excessive capacities, depending on construction cycle across various segments, began to come online from the second half of 2023 through the first half of 2024. Therefore, by mid 2024, nominal capacity throughout the main solar PV chain exceeded 1,100 gigawatts, while global demand for 2024 is only expected to be around 600 gigawatts. This 600 gigawatts actually includes around 45 demand from the US market, which is partially inaccessible to China based suppliers. Therefore, the solar PV industry in China is currently facing a global oversupply across the entire supply chain.
Okay, I'm sure the most common question you get nowadays about the solar PV industry is when market equilibrium may be reached so that prices can start to recover. I know predicting the bottom of the market when it will start to recovery is really difficult. So maybe I can ask you the question in a different way. At what stage of market rebalancing is the industry now? And do you think this round of industry rebalancing could be longer and deeper than the previous rounds?
Mm, well, to start with the conclusion, we believe that prices across the entire supply chain in the domestic market have already bottomed. However, a significant price recovery may not occur until around mid 2025, as it will take time for inventory levels to decrease and there's rising uncertainty on demand outlook. The prices of the four major products in the main solar PV chain was influenced by supply and demand dynamics across various segments. Also, there are actually two key anchors, the price of polysilicon and the price of modules, representing the upstream and downstream ends of the supply chain. So since May, polysilicon prices have actually fallen below cash costs for leading manufacturers, leaving very little room for further declines. For modules, domestic prices are largely influenced by the bid prices of power companies' large projects. So after the China Photovoltaic Industry Association proposed in October a full bid price of 68 RMB cent per watt for modules, module prices have started to stabilize as well. So now, as you asked, the key question is how long prices will remain at this bottom level, and that indeed depends on demand supply dynamics. Given the absolute oversupply of capacity, market supply is primarily driven by the utilization rates of the leading manufacturers and the willingness to exit of less competitive second and third tier players. Until the first half of this year, market leaders maintained very high capacity utilization rates, aiming to deplete the cash reserves of smaller companies with less competitive costs and technology, thereby pushing these capacity out of the market forever. Yes, liquidity for some companies have been drained, especially after Asia IPO were suspended and some banks tightened credit lines for less financially robust solar companies. However, this round of capacity clearance has been slower than expected due to the lack of a clear market exit mechanism for some state-backed capital. Looking ahead, we believe this round of market rebalancing might require industry self-discipline to control production, as well as merger and acquisition to achieve supply side optimization. So we think it could take another 1 to 2 quarters before the market returns balanced status, conditional on no further deterioration in demand.
Okay, I would like to explore a bit more on the topic of eliminating excess capacity funded by state-backed capital. Do you think there needs to be a stronger response from the regulators and government to push for that? And what is your view on the effectiveness of the coordinated efforts by industry players and policymakers to curb capacity expansion so far?
Well, yes, one of the main challenges for Chinese solar PV companies in reducing excess capacity is that much of this capacity was newly built during the last expansion phase with significant funding from state-backed capital. And these facilities are relatively new in terms of technology and equipment, but the operational efficiency of these companies themselves is not competitive in some way. Directly shutting down this capacity could result in significant waste and potential losses of state owned assets. We've observed that recently the policymakers started to encourage mergers and acquisitions, aiming to optimize market exit mechanisms, and that might revitalize some of the quality assets of some lagging companies and provide exit strategy for those state-backed capital. But we think there might still be some mismatch between the expectation of the state um, back capital and the POE solar companies. So local governments and financial institutions may need to play a role in facilitating these deals in the future. Well, switching to your question about capacity expansion, actually in the first half of this year, capacity expansion has slowed because profitability outlook soared. In segments like wafers and modules, capacities have remained roughly stable over the past few quarters. And for solar cells, considering the transition from P type to N type technology, overall effective capacity growth has also slowed down. And in the polysilicon sector, following the commissioning of two major projects by Tongwei in the third quarter, no new capacities are expected to be online for economic reasons. Then there's a forecast by Bloomberg New Energy Finance that the overall capital expenditure by Chinese solar companies in 2024 will be 37% lower than last year and even below the 2022 level. We anticipate a further decline next year with investment mainly focused on technological upgrades and overseas capacity expansion. As of today, we believe that the first phase of market-driven consolidation has largely come to an end, and the second phase of excess capacity elimination indeed requires some policy intervention. What the policymakers have been doing is they recently raised the technological threshold for the industry to prevent the construction of inefficient new capacities and to eliminate some outdated plants. This is a common regulatory in China to address periodic overcapacity in industries that are experiencing rapid technological advances, such as electric vehicles and lithium-ion battery industries. Meanwhile, financial access of less competitive solar companies is narrowing. Equity capital market financing channels have been closed since the second half of last year, and this year banks have started to tighten credit lines. We expect the bank's whitelisting to further eliminate companies with weaker credit profiles. Concern then remains even after weaker players exit, there could still be excess supply from the remaining industry leaders. Well, the good news is that these players are actually negotiate self-discipline mechanism. Then following a seminar held by the industry association in mid-October to prevent malicious competition, and there are efforts to start with immediate production cuts in the polysilicon sector. However, we may need some more time to track the effectiveness of such a production control mechanism.
Now I'm going to ask you about Trump 2.0. We know China's solar PV supply chain is one of the industries heavily exposed to escalating trade barriers. Trump has threatened to levy a 60% tariff on imports from China. Obviously, no one knows when and in what scale he would implement the tariff hikes on imported solar PV products. But there is a high likelihood that there will be higher tariffs on imports from both China and other countries to which the Chinese companies have already rerouted part of their supply chains. So how do you see the potential further tariff hikes to impact the global solar PV supply chain?
Yeah, there's always high uncertainty regarding the tariffs. Under the Democratic administration, the United States actually has already imposed a new round of tariffs on Chinese solar PV products this year. On September 13th, the US increased Section 301 tariffs on solar cells and modules originating from China from 25% to 50% and introduced a new 50% tariff on polysilicon and the monocrystalline silicon wafers. Similar to the high tariffs recently imposed on Chinese electric vehicles, the political significance of these tariff increases outweighs their actual impact. Due to the multiple trade barriers the US had already established against Chinese products, those include anti-dumping and countervailing duties since 2012 and the Section 201 tariffs on all imports The direct exports of Chinese solar cells and modules to the US have significantly declined in recent years. Therefore, we'll say the US further import tariff increase against China made solar products will have a limited impact on the global solar supply chain. However, a greater challenge for Chinese solar companies this year arises from the decade long strategy of supplying the US market through production capacities in four Southeast Asian countries, that is, Malaysia, Vietnam, Cambodia, and Thailand. This strategy is now facing obstacles. The major one is that the Section 201 tariff exemption for these four countries expired in mid 2024. And on top of that, the US has set a series of barriers against Chinese companies producing in these countries recent years. These include bans on polysilicon sourced from Xinjiang and the circumvention tariffs and the new round of countervailing and anti-dumping investigations against manufacturers in these Southeast Asian countries. Despite this, the trade barriers set by the democratic US government are actually quite selective, leaving some market opportunities for Chinese companies. For instance, there used to be tariff exemption for the US direct imports of China-made bifacial solar modules. Also, the exemption quota for solar cells imported from the four Southeast Asian countries have been significantly increased this year. Additionally, manufacturing equipment for midstream and upstream solar products are also exempt from the latest Section 301 tariffs. However, the re-election of Trump now adds more uncertainty to the prospects of Chinese solar companies in the US market. We cannot rule out the risk that the new administration could impose comprehensive tariffs on the entire global supply chain of the solar industry, regardless of the location of production. Although this might even halt the development of the US solar power deployment, but that may not be a problem for the Trump administration, as they are actually considering abolishing the IRA, that is Inflation Reduction Act. So the growth prospects of the US market and its accessibility to the Chinese solar companies are both under a big question mark at this point. If we assume the US market was completely shut to Chinese solar companies, they will need to find new markets for their Southeast Asian production bases, which could further intensify competition elsewhere, especially as European demand is also expected to slow down next year.
That's all we'll cover on the Chinese solar PV industry today. It's a very insightful and productive discussion. And thanks, Jing, for joining the podcast again.
Thank you, Ying.
You have been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Please subscribe to iTunes, Spotify, or wherever you get your podcast. Take care until next time.